Could it be the moment for a 50 basis point cut by the BoC, October 2024, in light of a better-than-expected labor market report? The decision to continue with a 50 basis points cut despite improvements in the job market report makes a harder case to persuade the Central Bank Committee's decision. But if there's anything the BoC will likely reflect on, is concerns that the neutral rate is believed to have had dropped somewhere in the ballpark of 1.6%, well below the 2% inflationary target. Recent data revealed a stronger than expected performance in the Canadian job market, adding more permanent than part-time jobs. The unemployment rate fell to 6.5% in September, down from 6.6% the previous month, with the economy adding nearly double the number of jobs forecasted by some economists. This improvement suggests the labor market could throw a wrench in aggressive rate cuts. However, the interest for the BoC to cut rates by 50 basis points reflects deeper concerns about the ability to nourish the labor markets, which supports a turnaround in Canada's productivity. Despite the positive job numbers, underlying details indicate potential softening. For instance, the participation rate has dropped, and the number of hours worked has declined, signaling that the labor market may not be as resilient as what's being experienced south of the border. Adding, Canada's GDP growth and productivity reports have been underwhelming over consecutive reports. The economy continues to underperform with below-trend growth rates, raising fears that without intervention, the recovery could stall if further supports aren't administered. Indicators suggest it's in the BoC's best interest to stimulate economic activity and prevent further downturn by making borrowing cheaper and encouraging investment in the Canadian market. As the central bank faces a challenging balancing act with its decision on future rate cuts, while a deeper rate cut is intended to support economic growth, there is perceived risk that it could undermine currency stability, exacerbating the inflationary effects on imports. The effects on the Canadian currency argument has been somewhat negated recently by the Federal Reserve's decision on a deeper 50 basis point rate cut in September. Short-term concerns bring a position that cannot be ignored and outweigh those concerns that inflation will inadvertently change direction. A lack of support in the economy's productivity recovery could further delay the ability for the economy to get back on track in the long term, making it more challenging to balance out the sinking neutral rate. As the BoC continues to monitor economic indicators, future policy decisions will likely depend on a careful assessment of both inflation trends and economic growth indicators. The central bank's next steps will be crucial in ensuring that the rate cuts achieve their intended impacts without escalating existing vulnerabilities. Intentions to cut rates by 50 basis points underscores the complexity of the current economic conditions. While the job market shows signs of strength, broader geopolitical challenges further necessitate a proactive approach to monetary policy to build a more resilient market. The coming days will reveal whether such a bold move will be a necessity to curb those economic uncertainties the BoC faces in light of new data and increased conflicts in the Middle East. The BoC's decision will be closely watched by economists and market analysts alike, as it could set a precedent for future monetary policy actions. The balance between fostering economic growth and maintaining currency stability will be a delicate one, and the central bank's approach will need to be both measured and strategic. The outcome of this decision will have far-reaching implications for the Canadian economy, influencing everything from consumer spending to business investment. As we await the BoC's next move, the stakes have never been higher for the future of Canada's economic landscape.